Stan, how do you feel going into 2020?
About the markets or my health?
About the markets, the economy. We could talk about your health too if you like.
Let's not. Well, you have very low unemployment here. You have fiscal stimulus in Japan. You have fiscal stimulus and a lot of confidence coming to Britain. We're running $1 trillion deficit at full employment. Apparently we're going to have some sort of green stimulus in Europe. And we have negative real rates everywhere and negative absolute rates a lot of places. So with that kind of unprecedented monetary stimulus relative to the circumstances, it's hard to have anything other than a constructive view on the market's risk and the economy intermediate term. So that's what I have.
Because everywhere you turn, you're being encouraged to take more?
Well, I don't need to take more, I have enough, but I've always believed that expansions end usually with tight monetary policy or credit problems, and I think what we're doing is definitely borrowing from the future and will probably end badly as the 07 period did, but you know, that could be years. I'm 66, I might be dead by the time it happens. So the intermediate term, technicals are good, you have breadth at an all-time high, economy's fine, and if anything, our biggest problem going in, once the Fed shifted away from their QT and tightening program, our biggest problem was obviously global trade and worries over global trade. And I'm not saying everything is all peaches and roses now, but certainly on a rate of change basis, I don't see that being, if anything, there's a de-escalation, not an escalation there. So for now, all systems go.
So you're constructive, all systems go. How are you expressing that in your portfolio?
Well, I'm long equities. I'm long some commodities. I'm short fixed income, and I'm long commodity currencies, short the yen. So all sort of, for now, betting on a benign economic outlook and a benign market outlook. But as you know, Eric, I tend to change my mind, so that's for today. Hopefully it'll last at least a couple weeks.
Let's be a little more specific if we can. Short the yen, commodity currencies, I'm assuming Canadian dollar, Australian dollar?
That's very good.
Anything else I'm missing there?
I have some New Zealand lying around. I even have some Mexico lying around. They're not big, massive positions, but they're enough to matter in my non-competing world. I might have more if I still had clients.
Commodities have been unloved for an awfully long time. What do you own?
I own copper, believe it or not. Basically, I think on the margin, as I just described, particularly with fiscal stimulus and monetary easing at the same time and a diminution of trade worries, global economy is going to be better than the IMF thinks. And copper has a little extra kicker relative to the other ones. We think that EVs probably add 0.5% a year in demand, and the supply outlook's challenged. It become more challenged if the Chile situation doesn't clear up, but that's not why we own it. We don't own energy. Probably should, but I just think the demand outlook is so challenged long term. Just not that interested. If you like the commodities short term, it kind of makes the equities challenged because they're a long dated asset, and hopefully we'll go greener and greener. I am on the board of the Environmental Defense Fund, so I'm perfectly happy if oil doesn't go anywhere.
And in the stock market, anything particular you like?
It's interesting. When we met a year ago, my portfolio was heavily growth oriented, particularly the cloud.
It was ServiceNow, remember, Microsoft.
Yeah, the theory being there's like a 10-year runway and these companies would grow very well in a low nominal growth world. I still own that stuff, but my mix has changed dramatically to stuff that will do well in a higher nominal growth world. So I have banks, financials, I own Japanese. So I wouldn't call it a mix valuated. I wouldn't call it a mix dominated by value, but it looks more like a normal mix now. It's not just concentrated into companies that would do well in a low nominal growth world.
And short fixed income, which I interpret as short the treasury market, what a difference a year makes.
Yeah, last year the Fed was on this, well, about around this time they were about to do a hike, and Jerome Powell also followed that up by saying quantitative tightening, shrinking the balance sheet was on automatic pilot, and I think their dots called for 4 hikes.
Over the space of about a year, that's right.
I thought that those were inappropriate, and I think I looked at the transcript from last year. I think we were long quite a few treasuries, so it's almost the exact opposite view for the exact opposite reason. I don't think Jerome Powell will have the courage to raise rates next year. It's a lot easier to change your mind from a tightening to an easing mode, but I definitely don't think they'll be easing. It's kind of absurd when you look at where nominal growth and real growth in this country are, and you look at unemployment, and you look at all the other circumstances to have rates at 1.5%. If I came down from Mars and you showed me the broad landscape and asked me where Fed funds would be, I probably would guess 3.5, somewhere in there.
So if you don't think you'll have the courage to raise rates next year, should I imply that your short position is a little further out on the curve?
Yeah, we're short the long end because I just think these rates for these economic circumstances are inappropriate. I thought they were inappropriately high last year, or particularly the quantitative tightening, and I think they're inappropriately easy this year. It's actually quite remarkable because the Fed has continued to talk about this mid to late 90s period where they were doing insurance cuts. I remember running quantum at Soros, and in 98, credit completely dried up with Russia, and it looked like the Asian financial crisis could spill over into America. Greenspan cut 3 times, twice in October and once in November. Stock market went to a new high, took off, and since he was insuring against the Asian financial crisis, he took back the insurance. By the way, he had cut rates 3 times from 5.5 to 4.75, and then he started hiking. So the most fascinating thing about the recent press conference and the one before it was some reporter, I don't think it was a Bloomberg reporter, but some reporter cited this period and them using the insurance cuts as a model and said, Chair Powell, what happens if the trade war de-escalates and it's no longer that big of a worry, and what if Brexit is solved? Would you raise rates? And he said, absolutely not. And the guy said, well, why? That's why you cut them. You said that it was insuring against this. And he said, well, because the inflation rate is much lower now, and we didn't have the risk of deflation back then. And Erik, that didn't sound right to me, because I remembered distinctly that period, Greenspan running the great experiment with a booming economy with low inflation. I look back, and the core PCE was 1.5 in 98 and 99 when Greenspan started raising rates again from 4.75. It's currently 1.7, and he's got them at 1.5. I mean, honestly, I don't get these guys. Last year, when we met, no credit had been issued for a month. The stock market was down 10%. Economic conditions were in a meltdown, and they hike and they leave QT automatic pilot. Now, credit conditions are booming. We have a new IPO. Every day the stock market's an all-time high, employment's at 3.5%, confidence is picking up, and we just did 3 cuts. So it's like, these guys are pretty hard to figure.
I want to ask you some more questions about the Fed, but before I do, we haven't talked about your favorite currency. Were you long the pound heading into the British election?
I was. It is my favorite currency. And I just, you know, I'm very good friends with Johann Rupert, and he had told me he calls her Mrs. T, and that's Margaret Thatcher, and he said, you know, when I met with Mrs. T, she said, never underestimate the common sense of the British people. And I just felt that they were not going to go for socialism. And frankly, when I look at what's going on in Europe, and then when I look at what's going on in Britain, I was always sort of a Brexiteer because they did perfectly fine for 500 years without that union of countries down there who seem to all hate each other and they can't make a decision on anything. So I think this is going to be actually very good for the British economy. I separate myself from most on that. I think Boris Johnson is sort of a smarter version of Trump without some of the antics to go along with it, and I would expect investments to fly into that country, and I think they'll do very well there. So, you know, it's funny if you look at it. What if I were to tell you there was a Republican president, but a better version, and you had 2/3 Republican majorities in both houses of Congress, and you had a deficit to GDP of 2, not 4.5, and you had a debt to GDP lower than the United States, and 12 times earnings and a 4% yield, sounds like a decent place to invest to me. So we not only had the pound, and still do, we had the British financials, the banks, we have some Barclays, Lloyds, that kind of stuff lying around, which...
Just lying around.
Well, I don't take big positions anymore. I've become a coward since I stopped competing, but enough that it gave me a smile on Friday.
Let's go back to the Fed. You're a frequent critic of the Fed, have been over time, for reasons you've articulated well. You say you can't figure these guys out, but do you feel, Stan, any more confident about the direction of monetary policy today than you did a year ago?
No, I feel much worse. First of all, if you remember, a lot of the debate a year ago was about quantitative tightening. And despite the fact that at least the 7 or 8 previous times we had done QE, bonds had gone down and stocks had gone up, John Williams and some others there said that QT had no impact on markets. And frankly, we switched from QT to QE, and what happened? Bonds are going down in price, and equities are going up. But you know, it was just lucky 8 out of 8. But I just, first of all, the editorial Kevin and I wrote, we said don't raise rates for now.
This was back in December of 2018.
Yeah, our interview was the day before the hike. We wouldn't raise rates for now. We weren't saying to cut them. And one of the things we said in our interview is, if you hike now, you may get really scared and have to start cutting and do something drastic the next year, which of course they've done. I'm not sure why, but you know, I think it's always easy to be easing and things are great and you just feel like you're the cat's meow. You'll remember Bernanke claiming victory in 04 with the great moderation, and Greenspan was the maestro. But I will go to my grave believing that that financial crisis happened because of bubbles created by easy money. And I just don't understand why we need interest rates where they are now. We normalize, we're trying to normalize. Okay, things got too tight, should back off, but you don't need to go the other way to the extent we've had. And then this crazy president saying we need negative rates to compete with negative rates in countries where they clearly aren't working. They're not growing as well as I do. It's the most anti-capitalist idea I could ever dream up, and he's pushing Powell. And you know, I didn't want to believe this, but it's pretty clear now that he's had an effect on Powell. And of course, the media is going, oh, he's really standing up to him. Well, with verbiage, not in action. In action, he's been cutting and doing the president's bidding.
He hasn't gone negative.
God help us.
Some people say he deserved high marks, whether it's the media or others deserve high marks for resisting some of that pressure from the White House. What kind of grade would you give Jay Powell as Fed chairman?
Not a good one. I don't think he's resisted anything. He just...
Well, rate him against Yellen, Bernanke, Greenspan.
He's a weaker version of Yellen without the monetary framework. Bernanke and I philosophically disagree about easy money and helicopter money, but the man had conviction and he controlled the room, which I think is really important in a Fed chair. And I don't see that here. And of course, let's not compare him with my true hero, Paul Volcker, who...
The late, great Paul Volcker.
Yes, who he cited his courage, and I couldn't agree more, and it's too bad we don't have some of that kind of courage at the Fed today.
You brought up your friend Kevin Warsh, with whom you wrote the op-ed arguing for the Fed to pause and not raise rates, as it subsequently did, that is, raise rates in December of 2018. Kevin is considered a candidate for the job of governor of the Bank of England. Do you think he'll get it?
I don't know whether he'll get it, and I don't know whether he wants it. I don't know anything about this. But I hope for my sake it's not true, because he's been a trusted advisor, but who knows? Not me.
Stan, tell me what you think of Christine Lagarde as the new ECB president. It's early days yet.
She's a lawyer. I think it's way too early to judge her. I'm a little taken aback by linking climate change with monetary policy. I am on the board of Environmental Defense, so I'm a greenie, but you know, I think there's other buckets to execute climate change through, and it shouldn't have anything to do with monetary policy, but who knows how strongly she feels about that. But it's early days, and I think we should give her the benefit of the doubt and ask me in a year if we're still here.
Central bankers, whether it's policymakers at the ECB or, for that matter, members of the FOMC, seem determined at whatever cost to bring inflation back to 2%. In Europe, it's meant negative rates. Here, they're now beginning to talk about inflation averaging, maybe a catch-up period if it hasn't met the 2% target for a period of time. My question to you isn't whether negative rates necessarily work or whether averaging inflation is necessarily a good idea. You're free to answer both. But first, I want to know whether you think inflation matters anymore.
Well, first of all, there's 14 recognized measures of inflation. 12 of them are above 2%. Their preferred measure, the core PCE, is at 1.7%. The risks they are taking with regard to misallocation of resources, bubbles, all that stuff, because something is at 1.7 as opposed to 2, and now they're talking about a makeup period. First of all, monetary policy is supposed to look forward, not backward. So why are we looking backward? And if there's a makeup period, after inflation was 10% in the 70s, why didn't we have a target of -10 a year in the 80s? And we're talking about decimal points here, about something, Eric, that you can't even really measure. So, and I'd like to remind everyone, because now they've turned it into a mandate. There is no mandate for 2%. The mandate states very clearly price stability and full employment.
In this country, yes.
Well, I live in this country, and so does the Fed. And I don't know how 1.7% is not like the greatest success ever if we're talking about price stability. So this thing about it's the greatest challenge of our time to get it from 1.7 to 2, when we don't even know whether it's 1 or 3. It's just, you know, the measurements are so random. I just find it astonishing.
We're living in a time of technological advancement, all kinds of new innovations that are creating deflationary pressures, surely reflected in that 1.7, whether you think it's adequately or accurately measured. Where does that fit into your thinking about the importance of inflation at all?
I'm glad you asked, because you know when the last big technological revolution was? It was the late 1800s. And we had 3% deflation and 8% real growth for 10 years. So I remember talking to a central banker. So medical is 19% of GDP here. What if you found a way, either through co-payments or whatever, to get the consumer to respond to price, and then you used our technological wonder kinds, let's just call it for no better term, what if we Amazoned the whole medical system and you drove the costs of medicine, not medicine, of healthcare down in this country from, say, 19 to 13. It's 11 in most other countries. Would the Fed then panic because it sends the CPI under 0? Is this some horrible thing that it's going to be the greatest crisis of our time and have a huge response to? No. And I would say the same thing about all this stuff writ large. You have these magnificent productivity increases going on right now at the corporate level because of cloud content and so forth. There's nothing pernicious about inflation if it's driven, deflation if it's driven from the supply side. I don't see people walking around, oh my God, I'm not going to buy a car this month because it might be cheaper in 3 months. And by the way, we haven't even had deflation. It's just sort of this imaginary thing that it's not up to their 2% arbitrary target.
For the time being anyway, this obsession, if we can call it that, with inflation has driven these insurance cuts and helped once again to reflate financial assets. 2019 was an extraordinary year for investors. How did you do?
Not as well as I would like. I just got into double digits. Last week I wouldn't even been able to say that. I'm just too conservative in my old age. I was well positioned, but very timidly. I'll leave it at that.
Why are you timid? You got nothing to lose.
I have a lot to lose. That's one of the reasons I'm timid. I don't know, when I was competing and managing other people's money, I'm a very competitive person, and I felt the compulsion to take risks. I'm still a competitive person, but it's either that or something about my age, I don't trust myself, or the last year in particular, I've just never trusted this administration not to do something that would preclude me from taking positions that I just felt were safe and secure and all in risk. And I think, unfortunately, a lot of people probably felt the same way. As you know, people have actually sold equities and put them into bonds this year. I didn't do that. I was just timid about what I did do. But this administration, with wondering about where the hell the next bomb is coming from, just doesn't allow me to take some of the positions I've taken historically where I just thought it was a one-way bet. To me, this was always binary and a two-way bet.
It's not just policy uncertainty, it's something, what would you call it?
Policy uncertainty is a great term. One of the reasons I'm pretty sanguine right now is I think we're close enough to the election, and at least we can breathe for a few months, that I don't expect any dramatic policy that can overwhelm the favorable backdrop of monetary stimulus and a decent economy.
You describe yourself as being timid, maybe we'll use the word cautious, in part because you're no longer competing. There are still lots of people who are competing, and yet many of the greatest fund managers we've seen in our lifetimes are struggling to generate good returns. Why?
Well, if you're talking about the macro community, where the biggest problem has been, they're just not the opportunities there were in the 80s and 90s, because with central banks suppressing interest rates, there has not been sort of the one-way high risk reward bet. There were, I remember when the Japanese, when Mieno inappropriately tightened after a big bubble, I bought Japanese bonds at 7%, okay? And I mean a lot of them when I was at Soros. Okay, are you gonna go plow into the 10-year at 190 or whatever it is? No, but you might think rates are going down, so you just take lesser of a position. I also think a lot of them seem to be led around by the nose by the Fed. And the Fed, they talk about the dots and they obsess over this. I always made my money when I felt differently the Fed and I went in the other direction, because once the Fed changes, you make money. And the Fed's been very wrong on the economy and on the markets and on policy. And I think those that followed them, that's a problem. The other thing that's happened, obviously, is you've suppressed currencies. But there are plenty of great young money managers who are killing it. Now, they're mainly in technology stocks. They were long the disruptor and short the disrupted. We'll see what happens now if the world is changing the way I think it is. But yeah, I think those are some reasons.
Who impresses you among the current generation of young investors?
I'd rather not say, because someone asked me that 7 years ago, and I think I cursed the people I answered. But let me say this. I think one of the reasons I had the record I did, I was the only person in my class in '75 who went to the securities business at Bowdoin. And there were, of the higher up schools in Bowdoin, I don't think anybody at the end of a 7 or 8 year bear market was going to Wall Street. So the level of competence I was competing against in the 80s and early 90s made me look quite good. Once you've been through 20 years of a bear market, these kids that all come in the industry in late 90s and 2000, not to mention the quants like Jim Simons and all those guys, they've all got like 50 IQ points on me. So, I just think one of the reasons it's tougher is a lot of really, really talented human capital has been brought in, and with the internet, a lot of the old trade secrets that I had that were in my head about what leads and lags markets. Now Ned Davis is sending you like 5 emails a day telling you if this happens and that happens. You just don't, I think a lot of these investors don't have the edge we had back then. I was extremely fortunate to come into the business, particularly the macro business, when I did, from both an opportunity set and who I was competing against.
Well, you've told me before quants have changed the game for fundamental investors, and people like you need to adapt.
Yes, we do.
So how are you adapting?
Well, I think we talked about this last year, but one of my big things that...
And you got beat up for it a little bit.
That's okay. One of my big things in investing was price action versus news, and gathering price signals from the market. And I think those price signals versus news were very effective for 20 or 30 years. Now with the quants, who respond to a different set of variables than we used to back then, I used to want to buy a stock maybe in what I would call the second inning. When something's gone that much, their models may have figured out that it's going to go back to the first inning before it proceeds on its merry way. What I've tried to adapt to is having a fundamental belief, and if they're creating volatility in the markets, using the volatility rather than getting abused by the volatility. But Erik, I'm not that secure in my fundamental beliefs, so I liked it better when I could just use price signals. But I've tried to adapt, and I'm doing all right.
I'm going to hold you accountable to something else you told me a year ago. You said at the time you thought we'd been in a global bear market for a year.
Yeah.
Not a correction in a secular bull market.
Yes.
And was going to be hard to escape. Was that the wrong diagnosis, or are we still in a global bear market?
Absolutely the wrong diagnosis. We're at new highs 12 months later. I'm proud of the fact that I pivoted before it mattered, but I couldn't have been more wrong. But I would say, until the last month or so, the U.S. was about the only one that continued in this kind of markets. But no question that was wrong. The question is, how long is this going to last? The answer is, I don't know.
Nobody knows.
Long enough that
maybe Jim Simons knows.
I'm not sure Jim Simons knows, but I bet his machine that he created knows, where he can sleep at night and the thing makes money for him. God, talk about nirvana.
So it's awfully hard, of course, to predict when the next downturn is going to come. Do you have any idea, Stan, particularly as someone who's made more money in bear markets than in bull markets, what will trigger it?
Yeah, if there's a political event, change of leadership in the White House, that goes to some of the anti-capitalists, I would think that would definitely trigger a bear market. Whether it would permanently end the bull market, I don't know, but that would trigger it. The other thing that would obviously trigger it is if by the end of this year we started to get enough inflation that the Fed started tightening. And then, of course, the other thing is if we had a credit event. And if you look at the credit markets, it's very obvious that you got a really lot of bad apples out there that are not being exposed because the interest costs are so low. By the way, one of them being the U.S. government. We're running $1 trillion deficit. Why? Because we can. In fact, a lot of these new professor geniuses think this is just a free lunch. But I would think it's one of those three events. A, political. B, change in Fed policy, because, you know, who knows when inflation turns? You can come up with a theory why it would turn. I kind of believe the secular forces will hold it down, but I've been wrong before, and I'll be wrong in the future. And then the third one is, and this is more what happened in 07, 08, the bubble just collapses on itself because things have just gotten so ridiculous. I don't think we're anywhere near there, but I've been wrong before. And, you know, these things seem to happen after elections. In fact, when I first came in the business, my first boss told me, just buy 2 years after the election and then sell the election. And then that worked. Like every 4-year period it worked until Bush tried to extend the cycle and for the whole 4 years, and we blew up.
Is that what you're going to try heading into this election?
What's that?
Is that what you're going to try heading into this election?
What?
Sell.
I don't know what I'm going to do. I'm only going to sell when I start to see the signs to say it could sell. I can have all these great long-term pontificating, but as a practitioner, you know, I can't really think about the long term, but I need to be aware of it so that I can pull the trigger to go that way.
Let me go back to your point about anti-capitalists. Would an Elizabeth Warren presidency really be that bad in your view?
In what respect?
Well,
are we talking about markets, or are we talking about the United States? What are we talking about?
Well, let's start with the markets, because that's how we got onto the point, and then you can expand.
Well, with regard to the markets, let me just put it this way. Every consultant that ever studied Duquesne said I have a negative correlation to the S&P and I do very well in bear markets. I think a Warren presidency would be very good for my business, but not necessarily good for America.
Is there a Warren hedge?
Well, let's see if it happens first, but yeah, you could just sell it. You could just short stocks. It's not real complicated, and you probably sell the dollar. I mean, there's all kinds of stuff. But I'm kind of on the other side, and this is not just Warren, of all this rhetoric out there, including the business community, about failed capitalism, and we need to improve capitalism, and capitalism is a failed experiment. So
you're on the other side, meaning what?
I think capitalism, I'm a dyed-in-the-wool capitalist who believes in free markets and believes in creative destruction and believes that. So I'm a little offended by the narrative in the media, not that it's anti-capitalist. Everyone's entitled to their own opinion. I don't have a monopoly on the truth, but on the facts. So I don't think most people are aware. Let's just take poverty in the United States. It was 26% a few decades ago. It was 16% in the financial crisis, and it's 13% now. It's at an all-time low. Is 13% poverty rate low enough? Absolutely not, and it's something we have to work on. But do you think 99% of Americans would guess too high or too low on what had happened to the change in the poverty rate the last 15 or 20 years, much less the last 5 years? Or let's look at globally. You've got, since 1999, when you had 1.7 billion people in the world in extreme poverty. The number today is 700 million. So 1 billion people have been lifted out of extreme poverty in the last 20 years. Why? Because obviously India and China adopted a free market model. And with regard to all this other talk about billionaires and so forth, so during that same period, you've created 2,500 billionaires, but you've brought 1 billion people out of poverty. So that means for every billionaire you've created, 400,000 to 1 have exited extreme poverty. Okay. Now, you can be for capitalism or you're not be for capitalism, but I object to the fact sets that out there which are simply incorrect. I gave you another one, and as you know, I'm not a great fan of the president. But the fact of the matter is, this income inequality talk, it really doesn't stand up to the facts. The middle class and the poor are doing very well. In fact, they're doing better than they've done in quite some time. Are they doing well enough? No. Are they doing as good as Jeff Bezos? No. But on an absolute basis, they're definitely improving relative to where they were 5 or 10 years ago. And you'll probably be astonished to know that if you take income after government transfer payments and negative taxes, which I think we all agree it should be total compensation, the top quintile has had the same percentage increase as the bottom quintile. Now, I'm not going to phony facts up here for you. The 1% have done better because they all own stocks. But in terms of the lower middle class, for the first time, they're actually improving relative to the upper quintile.
Here's how I would put it to you. In terms of political risk, at the end of the day, Stan, does it matter? Of course, the data do matter, but does it matter to those people who feel screwed or feel like they're getting screwed what the data show? To them, all that matters is how they feel. And how they feel is what they're going to translate into votes at the ballot box.
Why do they feel that way? One of the reasons is because your profession goes out and validates that feeling with a misstatement of facts on a daily basis. How many times have you heard how the poor and the middle class are getting screwed? Of course they're getting screwed relative to Jeff Bezos. But you know what? Again, to me, that's capitalism, and I'd rather have a rising tide where one group is not rising as fast as another group than I would have them all sinking.
I would also posit that it's not a binary choice between capitalism and raising taxes on billionaires, which is clearly what some people running for the Democratic nomination want to do.
Well, since most billionaires own stocks and assets, it's hard to believe they didn't, okay? I'm all for raising taxes on billionaires because, as you know, for years, including when I ran hedge funds, I've said I wanted to normalize capital gains, that we should be paying just as high a rate as the plumber's paying. I've been against carried interest, been against pass-throughs. All that stuff to me inside the tax code. Now that's not, well, I guess it is officially raising capital gains, but that's not officially raising taxes. But what it will do, it will raise taxes on the wealthy. I would also say there's another false narrative, how they've cut taxes on for the rich with the Trump tax plan. I don't know, you live in New York, I don't know about you, my taxes went up, they didn't go down. I got a tiny cut in my rate and I can't deduct state and local, so my taxes went up. I'm not complaining again, I'm just stating facts here. I don't object to the other side's argument. I disagree with it, but I don't object to it. Again, I don't have a monopoly on the truth, but I really object to a misstatement of facts out there.
Do you think capitalism...
And I think it's feeding this feeling you're talking about getting screwed.
That may very well be true, but at this point, heading into November of 2020, do you genuinely believe that capitalism as we know it is in question or at risk? Or is it just an argument around the edges of,
I think we
the
need,
system we have?
I think we need more capitalism, not less. To me, when you have a president of the United States who puts hundreds of billions in tariffs and then goes and picks and chooses individual economic actors who pay those tariffs and who don't, depending on...
Winners and losers.
Exactly. It might as well be the Politburo. When you have monetary policy around the world with negative rates, and you cannot have capitalism if you don't have a hurdle rate for investment. So we don't really have the markets allocating capital the way they would under a capitalist model. That's another version of it. You know, it's funny because Trump, if Trump gets reelected and things implode in the second term, capitalism will get a very bad name, in my opinion, and will probably have a big political response, but it will be under someone who's sort of the antithesis of capitalism. Then you've got the other side who want to villainize billionaires, which is okay. But their view is, if I take money away from this billionaire, that means the lower income levels are going to rise. Erik, that's not the way it works. That's like Trump's trade thing with a zero-sum game. If China loses, we win. No, you can both lose. It's the same thing with the economy. If you screw Jeff Bezos and he decides to take his entrepreneurship and go home, okay, this man has created 657,000 jobs if you take out the Whole Foods acquisition, all right? And, you know, all this innovation, all this stuff going on, and you reverse the economic wheel, we can both lose. Yeah, you can punish Jeff Bezos, but how do you really hurt the poor and the middle class? Bad economic policy. That's how you hurt them.
One of the things you've been doing for years already in an effort to maybe counter bad economic policy is give your money away. What have you been doing with your money lately, Stan? And do you think philanthropy has as bright a future in this country as it's had the past several years?
Well, first of all, I want to be clear. I don't give my money away because of bad economic policy. I give my money away because I can. It's hard to explain, but I was unbelievably lucky to be born in this country. I think the odds were 23-1 the day I was born, whether I would be born in America. And I can talk to myself about how I pulled up my bootstraps or this or that, but I could have been born in North Korea or Iran or Rwanda, and I'm kind of guessing I wouldn't have had the economic success I've had. Then the other thing I would say, in our system, I have a skill set. My mother-in-law says I'm an idiot savant. I was not in the top 10% of my high school class, but I'm very good at compounding money. And I just get a real pleasure, both emotional, of just trying to make sure other individuals have the same shot I had. I was in a bad school district. My father moved me. You know, I had an opportunity. Had he not moved me, I don't think I'd be sitting here today. And
I see. So it's not bad economic policy. It's you want to help people who haven't been as lucky as you.
I'm helping myself too. I love giving money away. It gives me pleasure, and to me it's a privilege. I think a lot of people would do it if they had the kind of resources I had. It gives me a thrill to be at Memorial Sloan Kettering and see them moving the needle on cancer. It really gives me a thrill to see that we're providing kids in Harlem and others the same shot, or at least a better shot at the American dream. So we, you know, one of the things we emphasize and we like to give to is economic mobility. There's a lot of very cool stuff going on. I'd say my latest and most passionate experience is with Blue Meridian. During my Harlem Children's Zone, well, I'm still, those days are continuing, but when we founded Harlem Children's Zone, Jeff and I, there was a woman at Edmond McConnell Clark named Nancy Rube, and they helped us set up our original business plan, and she did the due diligence on us for 20 years. And believe me, when you're on the other side of strong due diligence, you get to learn how talented someone is. So when Nancy told me that the Clark Foundation wanted to liquidate, and she wanted to set up this thing to satisfy the mismatch between all the wealth that's been created today, and then there's this whole incredible group of young social entrepreneurs out there who want to deal with the problem, but the money's kind of stuck here, and the supply of talent is here, and her concept was to transfer the money in there. You've got stuff going on like the Giving Pledge and all this stuff that shows an intent. Unfortunately, there's not a lot of movement yet, but I'm pretty optimistic given the intent and also given the talent that's out there in the social entrepreneur sector. Remember I talked about talent being drawn in the financial sector? It's amazing the talent's been drawn into this social entrepreneur sector. I think it's a sign of our times and everything we're talking about. So I'm hopeful, enthusiastic, excited that a platform like Blue Meridian that brings these funders together with these practitioners is going to work and deal with some of the problems.
What problems in particular?
Economic mobility, I think, is the biggest one. So Blue Meridian is funding place-based strategies like Harlem Children's Zone. Mm-hmm. They're funding nurse-family partnerships, which is, you know, early life, because obviously kids, if not properly attuned to their first 2 or 3 years, don't have the vocabulary and the chance. But, you know, just helping mothers, single mothers, give the same kind of attention to their baby that our children might. But there's a number of organizations across the board. But the idea is, if you take great leaders and you identify them. I was lucky enough to meet Jeff Canada, and you embody the same investment principles I've used in my lifetime in investing, which is find a winner, back them, scale them up, don't sell them, ride the winner, keep investing with them as long as they're innovating. And that's the concept here. So we're making big bets, putting the dream out there of $100 to $200 million of funding for organizations that we think can be scaled up that will solve the economic mobility problem, or not solve it, but put a big dent in it and give others a chance at the American dream.
So perhaps a little timid with investing, but not so timid in your philanthropy.
Definitely not timid in the philanthropy, and hugely excited about what might lie ahead in this country for it. And you know, I don't mean to be on a soapbox about this thing, but I know there's been some commentary about billionaires and their pets. I can just say that I think using the private sector to encourage innovation with these social entrepreneurs, and then if the model work, then plowing the money in there. That's a lot more exciting to me than giving the money to Mitch McConnell or Nancy Pelosi. I'd much rather give it to Jeff Canada or some of these other organizations, these entrepreneurs.